All right, we went through the direct write-off method and the other one. So now here's the other. All right, direct write-off method was the non-GAAP approved, but easy. Now we have the allowance method. The allowance method is GAAP approved. Journal entries are the same. We've got a couple of different allowance methods, and the only difference is how we calculate with the allowances, but the journal entries will stay the same. So it's only one set of journal entries. It's just how we do the math on the numbers that changes. Okay, so I thought this little grid would kind of help, or a little flow chart would help you see the different allowance methods to refer back to them as we go through these. So we got the allowance for bad debts. We've got two methods we're doing. We're doing the income statement method. And the income statement method is a percentage of credit sales. Don't worry, we'll get to the math on these. But it's the income statement method because we're using sales to calculate what the allowance should be. The other way is the balance sheet method. In the balance sheet method, we actually use a percentage of credit receivables. Right? It's the balance sheet method because receivables live on the balance sheet. That makes sense. Or we could do something called an aging analysis, but both of those are considered part of the balance sheet method. Okay, because again, with the aging analysis, you're going to be looking at accounts receivable to calculate the amount. Okay, so this is what we're going to do. We're going to do these guys for this one first, the percentage of credit sales, and then we'll move on to the balance sheet, the two balance sheet methods. Okay, so like I said, the journal entries are the same. It's just going to be how we calculate the amounts. So the adjusting entry for bad debt expense. The idea is at the end of every year, we are going to do this entry. So whether it's a fiscal year or a calendar year, we're keeping it simple and going with the calendar year. Our journal entry is going to be, we're going to use our best estimate to record bad debt expense. There we go. We're going to debit bad debt expense. And we're going to credit this account called allowance for bad debts. It could also be allowance for uncollectible accounts, but that's a mouthful. So we're going to keep it as a credit for allowance for bad debts. That's a new account for you guys. So here is our allowance. We're going to draw our little T account for it. And there's our credit. Now what is this allowance account? Well, this allowance account is actually a contra account. It's a contra asset, kind of the same way as accumulated depreciation is. And it's a contra asset to accounts receivable. So the way that works is if you think about it, accounts receivable carries a debit balance. Allowance for bad debts carries a credit balance. So you net the two of these together. You say, these are all the receivables I have, right? That's what's recorded in that receivables number. And then these are the ones I think are not going to pay me. And that's your allowance number, okay? And the idea is you net the two. So let's say you had $1 million in receivables, but you know probably 50,000 of them, it's kind of high, but whatever, 50,000 of them are not going to pay you. If that's the case, you don't want to report $1 million in your balance sheet because you're not going to really get $1 million. You're going to get $1 million less than 50 you think you're not going to get paid. So you net the two of them together, and that's why they're contra accounts. And then you would report, with those numbers I just used, $950,000. Okay, make sense? So there you go. And the netting of the two, when I do that, right, so I said I had $1 million here and I said I had 50,000 here. That netting amount is how much you're actually expecting to realize or get. So that's your net realizable value. That $950 would be your net realizable value. Don't worry, we'll do this with numbers. But the idea is that they don't want you GAAP doesn't want you reporting receivables that you're not actually going to get. Now you're probably asking, how do you calculate this amount? How do you figure out who's not going to pay you? That's going to be one of the things we do. All right. What do we do with this allowance? Well, it's kind of like a cushion, right? We're estimating a certain amount of people aren't going to pay us. And the idea is that as people don't pay us, we start using up that cushion that we set up for ourselves. And then we're going to start writing people off. So let's just do the journal entries for that. Write off of uncollectible accounts receivable. Okay, so we will debit allowance for bad debts. There we go. We're using up that cushion, right? That's the way we think about it. The cushion, the estimate. We use it up as people start to default. So we debit allowance for bad debts and we credit the receivable. We take that off the books and there's that credit, right? As people start identifying. So this big one, this original calculation is a big estimate. And then after that, individuals start to default, right? So we debit the allowance and we reduce the receivables for the people who default. Okay, so that's it. That's where you would stop. However, I'm going to take it one step further. What happens if somebody pays you? Again, what happens if you wrote somebody's receivable off that then turns around and pays you? So you take the same two steps that we did before with the reversal of the write-off. We reverse the original one. So this is the write-off entry, so we're going to reverse this one. We will debit AR, credit allowance for bad debts. And step 2, record the receivable as if none of this write-off had ever happened. So we would just debit cash, credit the receivable, the fact that we got paid. Okay, it's as if these two would cancel each other out. That's exactly what they would do, right? As if you draw X's through them. Their entries cancel each other out to 0. All right, so let's look at this with numbers. All right, this is one of the try-its, so I will let you pause. All right, now let's try it. Let's give you the solutions here. I kind of take, doing a little bit fast. Hopefully you have all of this here. Hopefully you have the right journal entries. What I did here, if you want to capture them and pause it, is I kind of tracked all of these entries as you go through it, which is really helpful to do because at some point you're usually asked for totals in these problems. Oops, too far. And it's helpful to have those totals. Okay? All right, let's move on. So how do we actually calculate the dollar amounts? Remember, the journal entries are the same regardless of which method we use, but the calculation is going to change. So the first one we're doing income statement method, percentage of sales. So it tells us, here we go, income statement method. Estimate based on the percentage of sales. Ooh, too far. Assume total credit sales of $750,000. Assume that 2% of them will be uncollectible. You're never going to come up with that amount, but the accountant in the business has to come up with that amount, the 2% number. You're going to be given that number. So the $750,000 in sales, credit sales, not just sales, but credit sales, because if it was a cash sale, you already have the money. There's no point, and it's got nothing to do with, nobody owes you the money. You're not questioning what you're going to receive. If it was cash, you already have it. The question is of the ones who owed me money, which of those are not going to pay me? So that's why it's always credit sales. So $750,000 at 2%, $15,000. So our journal entry for that is going to be debit bad debt expense, credit allowance for bad debts. All right, if you look back at those journal entries, that is how you do it. Okay, here's your little try it. Do the same thing. I kind of give you the how-to here. Pause it, try it on your own. Okay, and now I'll give you the solution step by step. Okay, and I give you extra information in here, the net realizable value, as I said, and whatnot, just because I feel like that's helpful for you to see. Well, actually, you do need to show how to report accounts receivable, kind of. This is the net realizable value. You report it on the balance sheet at the receivables minus the allowance. Okay. All right. Estimate based on a percentage of receivables. Now we're into the balance sheet methods. Okay. With the balance sheet methods, okay, I wanted to go back, but I'm not going to yet. With the balance sheet methods, what we have to do is we look at receivables. As before over here, this was just a percentage of credit sales, right? This is just, we knew this was our sales, $750, 2% of that we're saying is uncollectible. That's it. That's all the math we have to do, and we just book it. It's a little bit more complicated when we get to the percentage of receivables with the balance sheet methods, or either the balance sheet methods actually. So the unadjusted balance of accounts receivable is $200,000. 4% of that's going to be uncollectible. Okay, well, that's not such hard math, right? $8,000 is uncollectible. However, with the balance sheet method, you have to look at what's already in the allowance. So we've got a $500 credit balance already in the allowance. Here we go. This $8,000 that we just calculated is actually the amount we want to be in the allowance for bad debts. So it's got $500 in there. We want it to be $8,000. So how do we get there? We add an extra $7,500. So we've got a credit for allowance for bad debts for $7,500, and we have a debit to bad debt expense for $7,500. All right. So the reason this method is different is because you're looking at receivables very carefully. You're saying, of all the receivables that I have, I want the number, the final number in the allowance to be $8,000. Okay, so you have to look at what's in there beforehand, right? Before you start making your adjusting entry. Income statement method's different. Income statement method, just percentage of credit sales, throw that on top of whatever is in there, or whatever is already in there. So you calculate, let's say that you'd calculated this was 8,000, it was percentage of credit sales, you would have just added that into the 500, you would be at 8,500. The idea is that that one is a little bit more straightforward. This one, you have to take into account the balance sheet methods, what is already in there. So now, that was if there's a $500 credit balance in there. What would happen if there's a $500 debit balance in there? Okay, so we're looking at it differently. We still want the number to be 8,000. So we still want that. So what we're going to do is we need to credit it for 8,500 in order for that to work. That's why it's really helpful to see this in a T account occasionally, because then you go, oh, like if you'd made that mistake, you would have seen that the math wouldn't have worked. If you put 7,500 in there, you would have seen 7,500 minus 500 is 7,000, not 8,000. So you would have seen you needed that 8,500 in there. Okay, but again, balance sheet method, you have to take into account what is already in there when you do the adjusting entry. All right, so I'm going to give you this. Try it on your own, and then here's the solution. Oop, too far. There you go. Hopefully you got there. If not, like I said, I try to follow all these numbers along so that you can see how to do the math here. All right, so I'm going to turn this off. I'll see you in the next round. We'll do the aging analysis.